Imagine a man at a swanky Manhattan diner in 1950 reaching for his wallet, only to realize it's gone. This embarrassing moment gave birth to a radical idea: a single card you could use anywhere. In February 1950, Frank McNamara and partners quietly invented the first modern credit card, the Diners Club Charge Card. That little cardboard charge card, paid in full each month, would grow into a $100 trillion machine reshaping global finance. If you're into hidden financial systems and how money really works, hit like and subscribe. Profit from Payments channel. Let's dive in. Before Diners Club, buyers paid cash or used store charge accounts. McNamara's restaurant wake-up call led him to launch a middleman company, issuing a single card for multiple merchants. Initially made of paper, the Diners Club card was accepted by just 14 New York City restaurants and given to 200 insiders in 1950. Diners Club charged restaurants a steep 7% fee on each sale and cardholders a small annual fee. By year's end, 20,000 people were using it, a status symbol for traveling salesmen. McNamara had cracked the code. Consumers loved buying now and paying later. Soon, every department store and oil company wanted in. By the late 1950s, Bank of America launched the BankAmericard in 1958, the first general-purpose revolving credit card. Amex rolled out a card in 1958, on paper at first, plastic by 1959, and a group of banks formed Interbank or MasterCharge in 1966, later to become MasterCard to compete. Crucially, these cards let you carry a balance month to month and charge interest, a distinction from pure charge cards. In fact, BankAmericard's network eventually split from Bank of America and rebranded as Visa in 1976. The 1960s and 70s saw explosive growth. By 1970, only about half of US households had a card, but by 2023, roughly 82% of adults did. In short, plastic has gone global. 3 companies, Visa, UnionPay, a Chinese giant, and MasterCard, now process over 97% of all credit card transactions worldwide. The 4 major US networks, Visa, MasterCard, Amex, Discover, together handled approximately $26.1 trillion in consumer transactions in 2023. In the 1980s to 2000s, credit cards went from convenience to necessity. Banks used deregulation and new computer systems to flood the market. By 1999, there were about 365 million US credit card accounts. By Q1 2025, that number had jumped to 631 million, a 73% increase. Interest rate caps fell, and issuers cranked interest rates sky high. The average US credit card APR is now about 24%. Consumers lured by rewards and easy credit charged everything to plastic, from groceries to mortgages. The 2000s especially saw a debt frenzy, subprime lending, exotic products, culminating in 2007 to 2008. Credit card balances briefly dropped during the crisis, but by early 2025, US revolving card debt is back over $1.3 trillion, about $10,700 per household. That's down from a 2022 peak of approximately $1.7 trillion, but still enormous. Today, nearly all income levels juggle card debt. Many households pay only the minimum each month, accruing interest that greatly inflates their costs. Late fees and over-limit fees add to the pain. In short, the consumer is often caught in a slow debt trap, yet card spending powers the economy. Americans swipe cards for about 75% of all retail purchases, and similar high adoption is seen globally. Emerging markets adopted cards too. China's UnionPay emerged as the largest network thanks to China's population, surpassing Visa in volume in 2015. But here's the bigger point. Cards have become essential. We no longer live in a cash-dominant world, especially in the US online shopping, subscription services, ride-sharing, food delivery, and even mobile wallets like Apple Pay and Google Pay all run on the same card rails. Whether you're buying groceries in-store or paying for streaming services, a card is your passport to modern commerce. In effect, plastic quietly edged out cash and checks to become our default global digital currency. The credit card ecosystem can seem opaque, so let's break it down. Every time you swipe a card, 4 key players work together. 1. Issuer. The card issuing bank, such as Chase, Citi, Capital One, extends credit to the consumer. It issues cards under Visa, MasterCard, and Amex logos. When you swipe, the issuer authorizes or declines the charge. The issuer makes money from interest on unpaid balances and fees. 2. Network. The card network handles the data routing between merchants and issuers. It maintains the global infrastructure like VisaNet and sets interchange fee schedules. Visa and MasterCard themselves don't lend money or issue cards. They run the network, brand, and rules. 3. Processor or acquirer. The acquiring bank or payment processor, such as Square, Stripe, Fiserv, signs up merchants and processes transactions. When you charge a card, the processor contacts the network, then the issuer. The issuer transfers funds to the acquirer, minus the interchange fee. Finally, the processor deposits the remainder into the merchant's account, minus the processor's own fee. 4. ISOs and agents. Independent sales organizations act as the bridge between merchants and processors. They're the ones who sign up merchants, provide customer support, and manage the ongoing relationship. For that work, they share in the processing revenue, usually earning around 0.5% to 1% of the merchant's total card volume. In equation form, customer swipes, merchant terminal, processor, acquirer, network, issuing bank, back down to acquirer, merchant's account. Along the way, each party tacks on a fee. The issuing bank keeps the interchange, the processor keeps its fee, and the network takes a slice for network assessments. This multi-step flow means every card purchase generates revenue for several players. Visa and MasterCard set the interchange, often a percent plus a few cents that issuers get. Banks profit from the interest on carried balances and annual fees. Processors profit by marking up interchange and charging monthly service fees. Even tech companies, such as Apple and Google, take a cut when you tap your phone, since these payments still flow over Visa or MC rails. Understanding this flow explains why credit cards have become so lucrative and why merchants often hate them. It's like a hidden toll booth on every transaction, enriching banks and networks at the expense of buyers and sellers. Credit is far from free. Every card swipe feeds a network of players taking their cut. And while merchants and consumers see it as a cost, those same fees create one of the most powerful recurring revenue streams in finance. Merchants typically pay 2 to 3% per transaction, averaging 2.2 to 2.4%. In 2023, US merchants paid nearly $172 billion in card swipe fees, with over 80% flowing through Visa and MasterCard branded cards. Most small businesses can't negotiate lower rates. They simply build the cost into prices. The advantage: agents who help merchants set up processing earn recurring income month after month. Merchants in high-risk industries face 3 to 10% plus per transaction, plus account fees and rolling reserves. Because mainstream processors avoid these merchants, agents who serve them capture far higher margins. Payment facilitators specializing in industries like online gambling or CBD charge premium rates because default risk is greater. The risk that keeps big banks away makes high-risk processing exceptionally profitable for specialists. Cardholders pay annual fees on premium cards, late fees $25 to $40, penalty APRs exceeding 30%, and cash advance charges. Together, merchants and consumers feed a $170 to $180 billion annual pool into this ecosystem. The average US household indirectly pays over $1,100 to $1,200 yearly in card-related fees. Every free points card hides a toll booth. While most money flows to banks and networks, agents can capture their share by helping merchants process payments. A merchant processing $100,000 monthly could generate $500 to $1,000 in residuals for an ISO or agent. Multiply that across dozens or hundreds of merchants, and the opportunity becomes clear. The winners are obvious: payment networks and big banks. Visa's 2024 net income was approximately $17.7 billion on $35.9 billion revenue, greater than 50% profit margin. MasterCard's 2024 revenues were approximately $28.2 billion, with approximately $12.9 billion net income, approximately 40% margin. JP Morgan Chase earns 45% net margins on card portfolios. Compare that to approximately 3% retail margins. Who pays? Consumers and small businesses. Networks negotiate with issuing banks, pass costs via interchange to merchants, and processors carve out their slice. High-volume merchants may negotiate, but most small businesses accept 2 to 3% charges as the cost of doing business. Even regulatory pressure barely dents the system. A recent settlement trimmed swipe fees by just 0.04%, while networks simply raise other fees elsewhere. The machine keeps spinning profits sky high. Technology is transforming payments, but plastic still reigns. Mobile wallets such as Apple Pay and Google Pay and even contactless chips still run on the same Visa and MasterCard rails. Buy now, pay later services like Klarna and even many crypto companies ultimately settle on existing card networks. Shifts are emerging. E-commerce, peer-to-peer apps, and instant payment systems are trying to sidestep cards, but adoption is uneven. Some countries lean toward QR codes and mobile pay, yet even there, card networks partner with the tech giants to stay at the center. Plastic credit is simply too entrenched to topple. As of 2025, Visa, MasterCard, and UnionPay process almost all global card payments. They invest in AI fraud fighting, partner on digital wallets, and acquire fintech firms to remain dominant. The $100 trillion machine will evolve, but it will keep rumbling along, invisible, inevitable, powering commerce everywhere. And here's the part most people miss. You don't have to just watch this machine from the sidelines. You can actually step into the flow. By partnering as an agent or ISO, you can capture a share of the very same fees that fuel banks and networks, turning every swipe into a stream of recurring income that grows with every merchant you add. Credit cards quietly reshaped the financial system in just a few decades. What began as a solution for one forgotten wallet became the backbone of global commerce, a system moving trillions every year. From Diners Club to Visa's empire, it's a story of innovation, scale, and profits siphoned from Main Street to Wall Street. But now, the curtain is pulled back. The system that banks built to enrich themselves is also accessible to you. Understanding this infrastructure is the first step. Acting on it is the next. If you found this expose eye-opening, hit like and subscribe to Profit from Payments for more deep dives into the systems shaping money and guides on how you can claim your share.